Thanks everyone for joining us. Look, we thought we'd get together, Seb and I, and give a bit of an end of year wrap. Just a quick update on all the three funds and portfolios that happens at PAC Capital. Bit of a macro update and just touch in for the year, what's happened and what's ahead. So first of all, I'm Clay Larkham, the Chief Investment Officer at PAC Capital, and Sebastian Lander is the Portfolio Manager here at PAC Capital as well. So Seb, thanks for joining us.
Thanks, Clay. And we'll start with a quick macroeconomic overview. We'll then touch on the performance of the different asset classes that we hold in the multi-asset portfolios. And then we'll finish with a position and an outlook summary. So maybe I'll dive straight into the macroeconomic overview. So look, 2022 was really characterized by two major drivers, and that was inflation and interest rates. So we entered 2022 with central banks just about giving up on the idea that inflation was going to be transitory. And it's proved to be anything but. Inflation has remained high. It's reached record levels going back sort of 30, 40 years in different jurisdictions. Nearly 9% in the US was the high for inflation. We're at 7% roughly in Australia right now. In Europe and the UK, we got to over 10%. And in response to those, those very high and unpalatable levels of inflation, we're seeing central banks enact swift tightening of monetary policy. And that has been primarily in the form of rising interest rates. So on the back of that, we've seen some pretty big moves in asset classes.
Mm-hmm. They're big numbers.
They are. Yeah, for sure. It's something we haven't seen since the sort of 1980s, really. And, you sort of, I think to contextualize it, as I said, we started sort of 2022 and it was only sort of the back end of 2021 that the sort of the Fed and other central banks said maybe inflation isn't transitory. But we began the year with markets and the Fed expecting circa 1% of interest rate rises. And what we've actually had is the Fed has raised rates from sort of 0.1% to 4.25 to 4.5%. Our own RBA in Australia has raised the cash rate from 0.1% to 3.1%. The ECB's gone from minus 0.5% to plus 1.5%. And banks are signaling further rate rises in 2023. So it's been an unprecedented year.
Yeah, exactly. And probably that leads me into sort of just talking on, PAC portfolios. How are we positioning it now? And let's talk about the different asset classes.
Yeah, sure. Okay. Well, maybe I will do that quick summary of asset classes.
Please.
So I'll start with equities. Look, it's been a very tough year for equities. When central banks tighten monetary policy this swiftly, and compared to the start of the year, it's been quite unexpected, the level of tightening that's taken place. And that has impacted the valuations of equities, particularly in that more speculative, the sort of non-profitable tech areas of the market. They've been hit very hard. But at the index level, we've had some big drawdowns. The Nasdaq's down 35% peak to trough. The S&P 500 fell 25% peak to trough. The ASX, which has got more of a value sort of tilt in the index, has done better, but that still fell 15% peak to trough. So there's some pretty big moves. If we then look at bonds, we've also seen some big moves there. Not the same size as we've seen in equity markets, but from a bond perspective, these moves have been massive. We sort of had some of the broad sort of composite indices down 20% for the year, peak to trough. And when you sort of think about bonds traditionally, especially when you're building multi-asset portfolios, you think of bonds as your diversifier, as your bellwether, as your safe part of your portfolio that's meant to offset losses that you see in your growth assets. That just hasn't been the case this year because, as markets have sort of, as central banks have moved up cash rates, we've seen yield curves reprice, and anything with duration in it has sort of sold off and experienced losses. So, those government bonds, as I said, traditionally were diversifiers for your equities, have just been hit as well. So it's been a really tough year for equities and bonds, and a really tough year for multi-asset portfolios.
What about like property and those other asset classes?
Yeah, so property has suffered as well, because again, with rising interest rates, you sort of you increase the discount rate that you apply to the future cash flows you receive on a property. So again, the valuation as the sort of the net present value comes down has been impacted. So we have seen big falls in property, but that generally has been confined at this point to the listed markets. So unlisted property has held up pretty well, and that's something we'll touch on in alternatives. But unlisted assets have had a very good year. Closely linked to property and sometimes put in the same bucket is infrastructure. Infrastructure, again, has come under pressure because the same rules apply. You know, you've got these long-term cash flows and you need to apply a discount rate. As that discount rate rises, the present value falls. The one difference though is that often infrastructure companies have inflation-linked cash flows. So in their contracts that renew periodically, there'll be an explicit link to inflation. So with inflation being so high this year, some of those cash flows have sort of repriced at sort of increased or higher increases than one would have expected. And that's meant that some infrastructure assets have held up better. Certainly in the listed space, so they have come off. But again, in the unlisted space, at the moment, valuations are really holding up well.
Yeah, that's good. And that probably leads me into there's a lot of red numbers in that discussion.
Yeah,
NASDAQ and property and everything seems to be under pressure this year. But you know, I know Seb and I and the wider team talk, you know, consistently about how we see the year ahead. But maybe from your side, Seb, multi-asset portfolios, how do you see this outlook coming for the year?
Yeah, look, I think you know, there remains a lot of uncertainty, right? Inflation, although it has rolled over in some parts of the world, notably in the US, you know, we don't know what the trajectory of inflation will be from here. We all hope it comes down swiftly, which will take some pressure off central banks, which means that they won't have to continue to raise rates. They may be able to pause. Look, they may even be able to cut. If inflation falls precipitously, there isn't really a reason for rates to be this high when growth is not as strong as one would hope. So yeah, look, I mean, I think the outlook is uncertain. I think with so much tightening having taken place in 2022, you know, the effects of that on the economy are still yet to be seen. You know, we all know monetary policy affects economies with a lag. So 2023 will really be about what impact does the tightening of central bank policy have on economies, on consumers, on company earnings. It's pretty uncertain. I mean, we do have a bit of a non-consensus view there. We actually are relatively constructive. I mean, starting positions today are better than they were. You know, so we've got like PE multiples have contracted because indices are down circa, let's call it 20%. Earnings haven't really been impacted as yet. Consumers have held up pretty well. Unemployment hasn't jumped. So traditionally, when we head into a recession, you know, we start to see employment rise. We haven't had that yet. And our sort of non-consensus view is that we may not get that because post-COVID, what we saw is employers really struggled to find employees, right? It was, you know, there was this great resignation, quiet quitting. There was a lot of buzzwords around, but essentially employers struggled to obtain staff. Now we're at the point where I think a lot of employers have found staff, but they're going to be reluctant to let them go, I think. They may look back at previous history, at recent crises like COVID and think, well, we actually came out of COVID very quickly. Do I want to let staff go and then again have another 6, 12, 18 months of struggles to rehire staff? So we think that the unemployment picture may not deteriorate as quickly or as badly as some are envisaging, which will mean that the consumer can hold up better, which should support economic growth. We think the tightening in central bank policy will have an effect, but we think that a recession, if it does come about, will be shallower than many expect. So on the back of that, portfolio positioning wise, the portfolios are actually positioned quite constructively. So if you remember, PAC uses the PAC risk signal, which is our sort of shorter term asset allocation signal and guides us in terms of positioning. Today we're at 1, which means that the portfolio risk is calibrated to be broadly in line with the long-term risk targets, which is the risk targets broadly in line with the strategic asset allocation for the portfolio. So, you know, we are constructive. We do see some opportunities. Alternatives have had a great year. You know, hedge funds have exploited the volatility. Our own long-short funds have held up very well in what's been a very challenging environment. Unlisted assets have done well. We spoke about that earlier. Unlisted valuations haven't really cracked yet. We don't mind those areas. We are cognizant. I think you need to be very selective there. You know, we did see recently some large managers have halted redemptions on some of their unlisted property funds. We think there are some dangers out there, and you know, sort of there's a number of phrases out there. We won't go into them, but at some point we will see, you know, if there are any sort of I guess cracks appearing, and that's probably, you know, in the first half of next year. But we're pretty constructive on the outlook. Yeah,
it's good, and that's a great summary for how we see the year. And One thing I love about our team here at PAC, and especially with Seb and I, is sort of the leaders on the multi-asset side. We're really quite nimble and active, and we see volatility's back in listed markets, and it's not going anywhere in the short term. But we are more positive in especially the second half of next year, and it's probably time to tilt and take positions and over the coming months. So we are very nimble, we're active, and I love that about us, and especially Sebastian, who leads his multi-asset portfolio manager. We've got a great team. We finished the year really strong. So
Yeah, and I will just add one more thing to that. I think having the expert resources on the direct side, our analyst team is bigger than it's ever been today, and we can sit there in multi-asset, Clay and I, and talk about markets and our views, and I can call on Clay's expertise in the direct space. We can call upon our analysts and ask them, what are you guys seeing? You're speaking to companies, you're looking at company valuations all day, you're unpacking balance sheets, you're looking at cash flow statements. What are you seeing? Are you picking up on anything? And we can get that feedback, and sometimes we can pick up on trends a bit earlier than some of our peers who maybe, a purely multi-asset shop or maybe a multi-asset team that's quite segregated from the rest of the business. That's not the case at PAC, and that nimbleness is really beneficial to us.
I think that's a good point. Even on the long short or the direct side of things, because of our team that's specialists in that space, it allows us to cross over and share ideas really easily. But also, even on the unlisted private side, like that side is building out pretty deeply now with the PAC Private One Fund. But let alone that, it gives us a really deep access to these managers to say, hey, how are you seeing the private markets? Yeah. And that only going to help us, and also investors in the portfolios, and the performance. So it's a good way to finish the year.
Absolutely. And just to say one final thing I didn't really address when Clay asked me was the outlook in terms of performance. And we are quite constructive, because when you look back historically, challenging years for diversified.
Constructive is positive.
It is, yeah. We're not cautious. We're sort of constructive on that. We know that there's challenges ahead. We know that inflation could, go higher again. We know that the unemployment picture could deteriorate quickly. But at this point, we're actually quite positive. We're pretty constructive. And I think when you look back historically, during years of challenged performance for diversified multi-asset portfolios, the following year, the following 2 years, tend to be very strong periods for those portfolios. And this year we've seen record losses in bonds, very heavy drawdowns in equities. Anything listed has come under pressure. But look, even looking at cash today, you can get a better return on cash than you've been able to get in 10, 15 years. We just think from here, the starting point today, it looks a lot more fruitful for a diversified multi-asset portfolio.
Yep, I agree. And so, great summary for the year end. And, thanks, Seb, for all your work this year with multi-asset. You've led the team really well, and PAC's positive for the next year, so it's good.
Yeah, couldn't have done it without your support.
Thanks, mate. Thanks very much. Okay, well, the next PAC pillar to sort of touch on today, as an end of year wrap, is our private allocation. And by private, I mean the PAC Private One Fund, which is a really unique fund that we've created this year. And it's part of the multi-asset portfolio. So it's important to have Seb here next to me to sort of ask me questions or anything that we need for the shareholders.
So yeah, I mean, Clay, as you say, having access to such a unique opportunity is fantastic for the PAC multi-asset portfolios, and really not that many people have got access to it. So maybe we could start there and just touch on what is unique about the PAC Private One Fund.
Yeah, sure. Look, it started off as a fund of funds approach, because I have access to a number of connections in this esports ecosystem that I'm in. Yep. It started off with my connection to Bitcraft, actually. And Bitcraft is essentially the world's leading fund in early venture stage. Started off as an esports gaming fund, and now it has branched into token funds and other opportunity funds, and from a $50 million fund, it's now $850 million fund. Wow. So these funds open quickly and close quickly. So I was able to act quickly and got us a really good allocation in that, and that has allowed access to this PAC Private One vehicle to other managers around the world in this ecosystem. So it's not just a gaming fund. It has F7 Ventures. F7 is the 7 female founders who started Facebook with Mark Zuckerberg. They've broken away and started a private venture fund in San Francisco. Met up with them the other day. Very different tilt and focus, looking at, it has a health focus. It has a artificial intelligence focus. It's got a few different pillars in that.
Wow.
And I've tried to diversify through this. So we've got 5 key managers in the fund. We've got Bigcraft. That has a gaming tilt, but we also have an allocation to some other more exciting, token fund, which is in there. So you might look at that and go, wow, token's under pressure this year, which it really is. But in this earlier venture stage, it's actually, there's a lot of opportunities there.
Yeah, right.
That are companies that have come under pressure, that had a high multiple early on in the last couple of years, and are now, you can be opportunistic in this space.
Yep.
So we have a small allocation to Bigcraft, who are the leaders in that side, in that fund. So it's really unique because the fund of funds is where it started. And now we have the opportunity to invest alongside the managers or co-invest with the managers. And wow, I don't know how long we've got, but I could talk about the co-investment side for a long time. So probably the most exciting thing that's happened in the last, it's been happening 4 months, but the last 24 hours is Baze. Baze is it's the largest data provider or capture of data in the esports ecosystem around the world. So let's say you've got a very large tournament name or a tournament provider. You've got ESL or Riot Games or any of the game producers. They actually provide data to a small number of data brokers around the world. And you have these rights that may last for 1, 2, 3 years. And Baze has actually secured a very key right, which probably I'll wait till the new year to announce who that is. But leading into that, it's because of my relationship with Bigcraft in this. They know how close I am to the esports ecosystem. They know, Clay, you are the leader in this space, in what you do in the listed space, but also in the private space. They said, we want you to come on and be chairman of the company and help lead the company.
Wow.
Which is really exciting and a privilege for me. And we've made a significant investment in PP1 in this opportunity, and there will be significant repricing and upside in the new year, because we're probably not the forum to talk about it, but there's so much exciting things happening with Baze.
Fantastic. Fantastic.
So
Baze sounds like a really exciting opportunity, Clay. So, are there any other direct opportunities, perhaps some Australian-based companies we're looking at or have invested in?
I would like to see a lot more. I'd like to see a lot more Australian companies that we have a huge amount of talent here, and I think that that'll be a next year story. Where we're going to be trying to attract talent here to show us some ideas, and hopefully we can help invest in those companies as well. But at the moment, there's really just one significant fund that probably a lot of people know is close to my heart, and PAC is Picklebet. And Picklebet was, I was one of the early seed investors in that, and it's been an amazing rise. Now Picklebet we're just finishing off a completion of a raise right now. Okay. We're finalizing the valuations, but it will be closer to the $100 million valuation mark.
Wow, fantastic.
So it's been an amazing, from a company based in Brisbane, the 2 founders, Nick and Damon, who started this company, to now being a 50-person operation globally, and that this is just the start of a massive story for that company. So that is part of PP1 as well.
That's brilliant. So, that's brilliant. I guess that talks to the opportunity, right? When you are investing early stage, they're not all going to be winners, but if you do pick a real winner, it can be immense.
Exactly right. And the point in this fund is not to have 100 startup venture investments.
Right.
I really want to have 5 to 10 funds, and then have 5 to 10 direct investments that are winners in those funds that we can participate in the upside with. Alongside the managers, because I don't want it to be like really early startup capital.
Okay.
Because that's really for a deeper venture company who has expertise and has a 20-person team there. That my expertise, as you know, is to find opportunities and the managers, but also understanding which are the ones we want to, as I say, step on.
Yeah,
which are the winners in those funds I want to step on and go harder. So it's
nice.
it's going to be good.
Brilliant. And so PP1, is that vehicle closed now? There'll be follow-on funds if it is, I presume?
Yeah, we had a hard close on 50 million US was the size of the fund, and we're close to halfway there.
Okay.
And I only opened it sort of 3 or 4 months ago.
Oh, nice.
So it's been a rapid rise in obviously interest, but also the funds that have come in has allowed me to obviously participate in bays and a few other things. But yes, it's still open,
Okay.
and I'll probably make it more public in the new year.
Okay, brilliant.
So
Brilliant.
great way to finish the year. I'm super excited about this vehicle. Multi-asset has an allocation in there, as does Clearwater portfolios.
Yep.
That we now manage here as well. They're the two multi-asset providers who know that you should have a 3 to 5% allocation in these sort of more private venture style investments at the moment. So the other investors have come from private individuals around Australia, and look, we look forward to the year ahead.
Yeah, it should be exciting year.
Yeah. So to finish 2023, the last pillar at PAC, which has definitely been the biggest growth part of talent we've got outside here, is the hedge fund side of the business. So as an update on that, we've obviously have the esports specific fund, and we have the innovation fund as well. Both share similar thematics, around the world. They're both in this high growth tech side of the ecosystem, with esports are more of a tilt on those names because of everything that we know. We're more specialists in that area. So what a wild year that's been,
Yeah. Tech has been under pressure this year. Right?
Tech has been under pressure. The Nasdaq's down 35%, or close enough to that. That is the last numbers I saw was 60% of the Nasdaq was down 50%.
Yeah,
for
wow.
the year.
Wow.
And a lot of these names got caught up in that.
Absolutely.
Yeah. And now the important thing to note, as you know, Seb, and investors do, that this funds have the ability to be long and short. Now, this is very, very important because there are no innovation funds globally that are long short.
Oh,
Yeah. So we are the only hedge fund that essentially specializing in that space and in esports. So this is really important because to take short positions, you're essentially saying something is overvalued or at the wrong price, and we expect it to go down.
Yep.
Now, obviously, this year we're really proud of the way we finished the esports fund this year. The final numbers are still being finalised, but we're going to be circa 5% in the positive for this year at this time, and innovation is down, on the 10% side at the moment. So,
but that's still fantastic when you consider the area that they're investing, that they're focused on, and the performance of the broader sort of stocks in those worlds, right?
Absolutely.
Yeah.
Like we leave that year with those numbers, we're really proud of that. And investors are actually super happy.
Yep.
That wow, like you have navigated through this wild, messy year in this growthy tech side of things. When a huge number of these names are down 50 to 70%,
Yep.
It's because we have been really nimble. We've got an excellent team here that's grown, and we have taken really strategic short positions in the esports fund, but also in the innovation side as well. Which has worked really well this year.
That's fantastic. I mean, I know there's another Australian unit trust focused on sort of innovation, and I know at one point that was down 50% for this year, which is, it's very hard to come back from a loss of that size.
Yeah.
So would you say, I guess, what's helped us so much really is those short positions, or is it sort of being nimble as well, even on the long side?
Well, yeah, I think this innovation word it's been a big word the last few years, probably led by ARC. That started over there, and that's sort of down those similar numbers.
True.
Again, those are long only.
Right.
So of course you can pull levers with cash and being in and out of the market and timing those things, but I would say the leader of this year for us has probably been tilted on the short positions.
Nice.
At one time we were 50% short.
Yep.
Within the esports and innovation fund, and then we did tilt into the longer end now, which don't have as many short positions right now. And that has led to, it's been reporting season, obviously in the US, with some names did surprise us. Roblox is a big name in the esports and crosses over to innovation as well. This is an esports metaverse Web3 name that I think will they're doing really really key things throughout the ecosystem on this interactive. I'll get into the company if you want, but it's a big conversation, that one. Essentially, this guy's has surprised a little bit with users have gone down. I think that's just a global cyclical result of a bit of a downturn in economic conditions.
Yep.
I don't think it's a structural problem. I don't. We've done a lot of work here with the team. We're still a big believer in Roblox as a group, and it'll continue to be a big position. But yeah, it has come under pressure the last month. But again, that's we have to really control the weight in the portfolios.
Sure.
And that's a really key thing to being disciplined and strategic. In the fund, and we finished the year this year really happy actually with the way the performance has, and it's I know it's an allocation in the multi-asset fund, and given how wild these swings are, we only see positioning and upside really strong in 2023.
Yeah. I mean, I'll just say from a multi-asset perspective, if half my equity managers were up 5 and the other half were down 10, performance would be a lot better. I think, as I say, I think you guys should be very proud of that performance. I think it's excellent, and I think the key is you can look at the headline indices, but when you really think about where these stocks are focused, and the cohort of stocks that sort of you're looking at to be up 5 in one fund and down 10 in the other is a phenomenal achievement. And a lot of these are structural growth names, right? And at some point, those sort of growth numbers will kick on, and people will begin to to love those names again.
Yep.
So
yeah, exactly right. Yeah, thank you. And I think it's important too to touch on that short lever and that we do pull in portfolios. There are still some of these tech names around the world, or these innovation names, that have some pressure still to go.
Right.
I still feel like during the course of 2021 and 22, valuations were quite high, and raising money wasn't hard for these companies.
Yeah.
Like in the public market or private, and they continue to feed these their revenue numbers. But I think the market has seen through this now.
Okay.
And are now looking for profitability in these companies.
Right. Yeah.
And are looking for a clear path. Spending money, and these days are over. It's now time to show how are you going to last a long period of time as a company, and how are you going to stop your cash burn.
Yeah.
And these are things that we're really identifying here, and are either companies who don't have a clear path that are leaving the portfolio, or we're adding some who are providing us a bit more clarity on how they're going to get there. So it'll be a good year ahead.
Nice. Fantastic. Thanks, Clay.
Thanks, Seb.